Good morning and very warm welcome to Nest Insight. We're very, very pleased to have so many of you joining us. It looks like we may have over 100 people on the line from Nest, from wider external organisations, and it's really great that you've chosen to join us to hear more about this research this morning. We published this research on the millions of people who experience volatile incomes earlier this week, and we can already tell from the huge response that we've had that it touches on something hugely resonant and that something that many sectors and organisations can play a really important part in addressing. So in the next hour or so, we'll be sharing with you what we found during the Real Accounts project, what it tells us as we've lifted the lid on these real financial lives of so many people across the UK. You can read the report at our website, and we're looking forward this morning to sharing a little more detail with you. Firstly, I'd like to thank very warmly the organisations who funded this project, and without whom it would not have been possible: the Aviva Foundation, Fair for All Finance, and the Money and Pensions Service. Nest Insight's mission is to find ways to support people to be financially secure throughout their lives. We know that household financial resilience is important for everyone, a particular challenge for people on low and moderate incomes, and it's a vital pillar of economic growth. So that's why we wanted to look at the particular experiences of the millions of households living on a volatile income. And we wanted to do it in an innovative and insightful way, which lifted the lid on people's real financial lives through close examination of financial transaction data, but also through speaking with households directly over time, building a relationship with them and really understanding their lives. And where we've got to is identifying the volatility premium, as we're calling it, the cost, both financial and mental and personal, to these households. That volatility has a number of different causes, and what's clear is it's not going away. So we hope this research is playing a useful part in helping a system seemingly designed for regularity to better meet the needs of so many people. And our report offers some positive practical suggestions for policymakers, product designers and employers to reduce the impact of this hidden vulnerability. So I'm thrilled to be joined in this section by two of the researchers who directly spoke with participants about their experience for nearly a year and have worked on every aspect of the programme. First, we're going to hear from Anne Angston-Clark, our research lead for this project, to talk about how we conducted the research and what we found. And we're then going to hear from Dr. Hayley James, who's a Senior Research Fellow in the Centre for Personal Financial Wellbeing at the Aston Business School and also a member of the Nest Insight team here. And she's going to be sharing some of the case studies from our research in more detail. And please do keep your questions coming. So without further ado, I'm going to hand over to Anne.
Great, thank you so much, Claire, and good morning, everyone. Thank you for joining us. As Claire said, I'm a research lead at Nest Insight and kind of coordinated the project across our different partners. This was a partnership with Hayley's institution at Aston University as well as Glasgow Caledonian University. I will share a bit about what Real Accounts is, what methodology we used, and then particularly what we found around income volatility before handing over to Hayley to give you some concrete examples of the impact that income volatility has on households' finances, but also households' lives overall. Very briefly about Real Accounts. So Real Accounts was a long-term study of UK households' financial lives. And what we did was that we followed 51 households across England and Scotland for up to 10 months. And when I say follow, I mean we really developed a very in-depth, in-the-moment understanding of their finances, so their income, their spending, their money management, but also of their lives over that period of time. And we did that by combining two methodologies. So first of all, we asked participants and other adult household members, if they were up for it, to connect their bank accounts to an open banking app that was enabled by MoneyHub, which allowed us to see all the transactions that were happening. So money coming in, money going out, but also money flowing between different household members and different accounts. And then secondly, we met with households every month and we did a qualitative deep dive interview where we ran through the transactions to better understand what was happening and how they were connected to what was going on in people's lives, but also could ask follow-up questions. And in doing that, we really started to understand not just how households were managing their money, but also why, and how different household members were managing their money together. And so we want to share some of those insights with you today. Before we do that, I would just want to give you a bit of background on the methodology, because we get a lot of questions around it. The questions we set to answer were really around better understanding income volatility, specifically for low and moderate income households. And the reason we set out to answer those questions was because we realized that a lot of times surveys and questionnaires, etc., focus on annual income or maybe monthly income. And so what you're missing is everything that happens in between. And so we really wanted to see, how does income fluctuate throughout the year and how do people manage? But then also looking forward, what might be opportunities to help people manage better? And the methodology that we used, if we go to the next slide, as I just said, was a two-part methodology. So first of all, MoneyHub helped us develop an open banking app where households could connect their accounts. They could connect their current accounts, but also their savings accounts and other accounts that they had. And ideally, if they were open to it, not just the primary participant, but also other adult household members would connect their accounts. And it allowed us as researchers to then see money coming in, money going out, but also, and I think that was one of the most interesting things for me at least, money going in between household members and household accounts. So a lot of times when you do financial diaries, you look just at the stream coming into the household and the stream going out of the household. But we also saw the many, many, many streams that were happening within the household. And you can see some screenshots here. We could play around a bit with the data then in terms of looking at different categories of spending or of income, looking at different timings throughout the month, etc. But it really gave us a very complete picture of what was going on with finances in a household. And then, as I mentioned, we combined that, if we go to the next slide, with deep dive interviews. And so in those deep dive interviews, we met with participants usually for around an hour. We, in the first half, asked them about their month. We went through the transactions together, especially in the first few months where there's a lot of understanding you have to do around, why is this money coming in? Why is it going out? Why are you transferring it back and forth between your different accounts? But also just to see what happened in their month and why certain spending decisions were made or why income might have changed. And then we had different deep dive topics that we explored in those interviews as well, around debt and credit, around relationships, to get a fuller picture of people's lives. And so that together really gave us an incredibly rich picture of not just the money, but also the live part of a financial diary, I would say. And Haley's going to give a bit more detail of what that helped us understand. I will say, and I think we're going to share those at the end, that we have a methodology brief that we've written, kind of reflecting on the methodology that we used, what we learned, what was a lot more challenging than we thought, how we might do things differently in the future if we were to do this again, so that you can learn from our mistakes. And we also have a toolkit publicly available. So if anyone is interested in doing financial diaries research, we wrote up all of the tools that we used, again, lessons learned, and that's available on our website if you're interested in the methodology. Very briefly, who were the households that we're talking about? So they were spread across England and Scotland. You can see here that our sample was predominantly female. However, this is just the gender of the primary participants. So as I said, if there were other adults in the households where they were willing, they would also connect their accounts. Sometimes they participated in interviews as well. And so a female participant here doesn't necessarily mean that there wasn't a male participant also in our sample. About a third of our households were receiving benefits. And then one of our recruitment criteria was that at least one member of the household had to be gaining an income, not necessarily from full-time employment. That could come from casual work, it could come from a 0-hour contract, but there had to be some income coming in. So you can see there's quite a wide spread around full-time, part-time employment, being retired, self-employed, etc. And I will also say, and this was really hard to show on the slide, that for very few of our households, there was only one source of income. Most definitely, if there were multi-adult households, but even if they were just a single adult household, we're combining multiple sources of income. And I think that's one of our findings around how this can create additional volatility. The majority of our sample was white, but we did have Asian British and Black British participants as well. And we focused on working age population, but we had kind of a few participants at the margins as well, so younger participants moving into work, as well as older participants about to retire. So what did we learn? I'm going to give a very initial overview on what we learned around income volatility before handing over to Haley. So first of all, income volatility impacts more people than we think. There's often this perception that income volatility is really just an issue for a small part of the population, those who are self-employed, those who do seasonal work, for example. But what we found, and what others have found that have started to look into income volatility, is that it's actually incredibly common. And for a huge part of the UK population, it's their way of life, it's what they're used to. So there's a Resolution Foundation study that was done a few years ago that found that 4 out of 5 low-income earners have volatile pay. So the huge majority of those on a low income have volatile income, and so do 2/3 on a moderate income. In our study, we took quite a holistic view of income because we were looking at households and we were realizing most households have a primary source of income, which might be their salary, but they're combining this with benefits, with pensions from some household members, with additional income from maybe a 0-hour contract, as well as for single parents with maybe child benefit. We looked at overall income coming into the household, and we saw that on average for the participants in our sample, the average monthly variation was £505. That is almost as much as the ONS estimates the average UK household spends every week on keeping the household going. So imagine that every month you have a week more or a week less of money available to spend, and you're responsible for balancing that out month to month. And as you can see on the right, this was definitely worse for those on a low income. So the low income households in our sample had 35% volatility, while the high income, and we did not have many, but we had a few households that kind of went in between income brackets, had 16%. Nevertheless, 16% is still a considerable amount of volatility. And so it really spreads across income deciles, but it hits those who are already struggling the hardest. We wanted to really highlight that this isn't just because of one reason, but actually there are several factors that drive income volatility. The first one is obviously the type of work that someone undertakes. So 0-hour contracts, self-employment, changing shift patterns create income volatility. But pay patterns also drive income volatility. So we had participants who were paid weekly or who had variable pay at different times, who were paid 4 weekly. And so even if their pay was stable, their monthly income was changing depending on how many weeks there were in the month, for example. The number of income sources drive income volatility. So as I said, very few households just had one source of income. For a lot of them, that was not sufficient. And so they were combining it with different ways of making money, which then introduced volatility, as not all of them were reliable. Life events obviously drive volatility. So we saw people coming in and out of jobs, having health issues, having relationship issues that might impact their income. So those things obviously drive income volatility. And then lastly, there's a link between income volatility and your overall income level, both that it's more likely if you're on a lower income, but also the impact is harder on you. So if you have high income volatility while you're already struggling with a low income, that will have a much higher impact than if you have a high income. So all of these different factors came together to drive income volatility and its impact on our participants. And so I'm not going to go through them, but I just want to point out that with those different factors driving income volatility, for our sample, we developed 7 profiles that kind of describe the different types of volatility people were experiencing. Was it because they were combining multiple income sources? Was it because their pay pattern was different? Was it because of a life event that kind of kicked them out of a stable income? In our first impact brief that is available on our website, we talk about those profiles a bit more and kind of provide some case studies that you can imagine what that looks like to be on a different type of volatile income. And so that was our first finding. Income volatility impacts a lot more people than we think. Yet the system isn't designed for it. And at this point, I'm going to hand over to Haley to talk a bit about the system and how we found that our participants managed it. Thank you.
Thanks so much, Anne, and thanks to everyone who's joining us today. I'm Haley. I work at the Centre for Personal Financial Wellbeing. And for the last 2 years, I've been collaborating with Nest Insight and our partners at Glasgow Caledonian on this project, which has been a wonderful experience. Pretty intense sometimes, meeting participants and looking at their transactions on a monthly basis has been a real learning experience. In the project, as Anne said, we identified this kind of mismatch between what financial systems tend to expect and actually what people's patterns of income and expenditures actually look like in practice. So here we see this kind of expected calendar. This shows a salary that comes in at the end of the month. The bills come out by direct debit in the days immediately after, and there's also a kind of transfer to savings. Then we see spending happening steadily over the month, maybe with a kind of larger spend in the middle of the month, which might have been from saving, until the salary comes in again and the process starts over again. Our participants' financial lives looked more like this. So salary from the first job comes in at the end of the month, then some bills are paid, then there's some budgeting of expenses until an income from a second job comes in mid-month, when the remaining bills are paid and some money put into savings. Then there's an unexpected bill and savings are not enough to cover it. So what they do is they borrow from a family member to cover the unexpected expense as well as what they need for the rest of the month to get them through the month. Then when the salary comes in again from the first job, they immediately pay back the family member, putting them on the back foot for next month, and the whole cycle starts again. So you can see this is quite a complex actual kind of mapping of what the month plays out like in terms of your finances. And we found this was, really common for the people in our sample. This systemic mismatch has consequences for people who experience volatile incomes. And I'm going to talk you through 3 ways in which they're impacted, drawing on the kind of real life stories from our research. The first is that households end up paying more. And this relates to the poverty premium, which has been documented to increase costs because households can't afford to pay for things like insurance annually and therefore have to opt for more expensive monthly premiums, or they have to use pay-as-you-go meters rather than direct debit for utility bills. What we saw in real accounts was that volatile incomes complicated this situation and extended the effect of the poverty premium to middle-income households who, if they'd had a stable income, would have been better able to mitigate it. Becky gives us an illustration. She was a single mother who worked part-time and received universal credit. Her income was towards the lower end of our sample, and she had a detailed kind of budgeting system that helped her to manage paying for larger items, things like school uniform, which we saw her do in the first few months of the project. Then suddenly she received an offer from the council to move into a bigger flat, something she'd been waiting for a long time. She had to organise this very quickly, and it also brought additional costs in terms of moving, as well as affecting her universal credit. Just as she was settling into a new house, her car insurance was up for renewal, and is something that she would normally like to pay annually by using her budgeting system to spread the payments out. But as she'd used up most of her savings buffer already with the house move, she had to opt for monthly payments, which were around £250 more expensive overall. We saw similar incidences happen throughout the time we spent with our participants, where despite their best planning, unexpected and sometimes even positive changes, moving to a bigger house was great for Becky, but that threw their financial management out and had a knock-on effect on the costs they were paying. The second area is that households are missing out on opportunities to improve their financial situations because of their volatile incomes. We found that our households were really proactive and inventive about finding ways to manage their money that worked in their situations, especially when experiencing volatility. Our second impact brief that came out earlier this year went into detail about some of the custom strategies we saw amongst our households. And, it's really testament to their drive to get by and do well. However, having to employ their own strategies meant that they sometimes missed out on the benefits that formal financial products can offer. So, as an illustration, informal loans with friends and family don't help you to build a positive credit score. So Thomas on this slide here offers an example. He was a single dad who shared custody of his kids with an ex-partner, and he lived in an apartment with a flatmate. He was paid weekly, and his income varied from week to week depending on how many shifts he worked. Thomas had a really careful plan of which bills he had to pay each week. He kind of did a calendar each month, mapping out what was going to be going out when. And he split some of his more significant costs into more than one payment. So that was the case for rent and bills, which went to his flatmate, and his contribution to his children's living costs, which he paid to his ex-partner. Both of those people were okay with receiving the money in kind of chunks through the month. And this meant that, they could also be flexible. So if Thomas had to say, can I delay that to next week, for example, they were very easygoing with that. Other creditors or suppliers were not so flexible, and indeed it would have been really hard for Thomas to live in any other circumstances, for example, in a house by himself or flat by himself, without his flatmate who effectively buffered his pay volatility and irregularity. Another example comes from Milena, who had an innovative way of making savings work for her. She experienced a sudden drop in her income, and this meant that she had to use savings to try to get through a transitional period. She also at the same time needed to build up more savings to use as a deposit for a new flat. But she found that her normal savings account was too easy to access. But on the other hand, she didn't want to use something that was really locked away because she couldn't predict when she might need her savings. So she started overpaying her energy bill, knowing that it would require 2 weeks for her to get back any money from it. That worked for her, and she ended up building up a pot of £500 in her account. The downside was that she was missing out on the interest that she could have been earning on those savings in the meantime. The final consequence is that households are wearing out. What we mean by this is that managing volatility in your household finances is a huge burden, constantly monitoring and tracking and coming up with ways to make things work. And we saw the mental load, the stress and the anxiety that came with that. Here on the slide, we show a conversation between Chris and Susie, a couple with young children whose income was made up of a variety of sources and which all came at different times with varying amounts as well. They had a really complex system of managing their money to make sure they had enough for the bills they had to pay, which involved moving money around into separate pots. And this resulted in thousands of transactions each month. In this specific conversation, they're discussing what should be an easy task, planning their regular big shop. But with a tight budget and income coming in at irregular times, they have to think very carefully about which supermarket offers the best deals. And if ordering the shop in advance, which means they can access better deals, they have to assess when the money will be taken out of their account. And this works differently for every supermarket, which they discuss in this quote here. Working out which will be best for them ends up taking a significant amount of bandwidth and sometimes even ends up costing them more, or they don't have the food in the house when they need it. In contrast to Chris and Susie's experience, which was kind of a regular feature of their lives, Laura experienced a shock which tipped her already tense circumstances over the edge. Laura is a single mum who had recently come to the UK, and she was working 2 part-time jobs, one full-time during the week and one at weekends. She also received some support from her children's father, and this was irregular, and that kind of made her household finances more volatile. Suddenly, her employer made a tax error which reduced her income by £1,000 without warning. In that month, she then struggled to pay her rent and also had to drastically cut back on other spending, including cancelling a birthday party for one of her children. It was approaching Christmas, and Laura was really worried about being able to afford it. Luckily, a family member offered to host Laura and her children, so they didn't have to miss out on the festivities altogether. But the shock ended up having a lasting effect on Laura, especially because even after 4 months, she wasn't sure if her salary had stabilised again, if it had been corrected, and it became a constant source of stress for her. You can see in the quote in the slide, just how much this was impacting her. So the consequences of having a system that isn't designed for volatile incomes are really significant, and these put households experiencing volatile incomes on the back foot when it comes to managing their money. I'll now hand back to Anne, who's going to talk a bit about the opportunities here.
Absolutely. Thank you, Haley. Yeah, so as Haley just outlined, households are falling behind, they're missing out, and they're wearing out. And as a result of that, ultimately, they're falling behind other households, because if you are constantly focused on managing your today, you're spending a lot of your mental energy on making income and expenses match up within a volatile environment, you're slowly wearing out. It's really hard to move forward, and it's really hard to plan for the future. And so we see households over our study period kind of fall behind where they could be if they had a more stable income, if they had more planning security, and if they had to spend less of their energy on making things work in the present. But we don't want to leave you on this kind of depressing conclusion of our report, but really point to opportunities for action. We think that a variety of actors can make a real difference here. And part of it is just recognizing that income volatility is a really common experience across the UK, and changing our thinking from everyone gets a monthly salary that is always the same, to saying a huge part of the population does not get a monthly salary, or gets a monthly salary but still does not have a monthly stable income. And so what does that mean? First of all, for policymakers, that changes how you design policy. So thinking about, for example, programs that support people to save. If you have a volatile income, you might not be able to put away the same amount of money the same day every month. That does not mean that you cannot save. And we saw a lot of really creative saving strategies that households were employing. So thinking about inclusive policy design that takes into account people's situation and supports them rather than tries to fit them into a system that doesn't actually fit their reality. For employers, there's obviously an opportunity to reduce income volatility at its source. That might be by actually looking at pay timelines, pay amounts, etc., but it also might be by providing employees with tools and products that help them smooth their income, such as earned wage access, for example, or just giving more transparency around what pay is coming, what shifts are up, and helping people smooth that out over the month and over the year. And then for financial service providers, there's a huge opportunity, and many are already doing as much as they can to provide flexible, transparent, and accessible financial products and services that really meet households where they're at. I think you saw from the case studies that Haley presented that households that we had in real accounts were incredibly creative. They were creating their own strategies, from saving with an energy provider to making lots of transfers between accounts to budget, to having a very intricate informal loan system with friends. And so understanding these current behaviors and then designing products and services that replicate them, but in a way that doesn't make households miss out on opportunities such as interest, or that takes a bit of the mental bandwidth off the household so that they can focus on other things, would make a real difference. And with that, we'll leave it, and we're really excited to answer your questions and hear what you think. Thank you so much.
Thank you very, very much, Anne and Haley, for that presentation. And yes, we will get to as many of your questions from the audience as we possibly can. So please do use the question function to submit questions, and we will go to those. So while those are just starting to come through, I'll add just a couple of thoughts to open up for discussion. So Anne and Haley, I mean, every time we talk about this research, I'm so struck by how we're describing a group of people that's extremely financially savvy, extremely tenacious, organized, yet often find themselves having to use disadvantageous products and solutions, and overpaying the energy bill is just one of many, many examples. So in terms of a policy recommendation, can more financial education really be the whole answer to this? Where does that sit in what we think needs to happen to make the system better?
Thanks, Jake. Yeah, it's a good question. I think financial education definitely plays a role. And I think, you know, there were some of our participants that said things like, I wish I knew more, I wish I'd been taught more about how to do these things, how to manage these things. But I mean, in some cases, these the participants that we worked with, they already were very financially knowledgeable and very kind of skillful in the way they went about using these products and services. So I think some of it is also, I think there's a limit to how much financial education by itself can achieve. I think that we have to look beyond that to think more about how can we help to change the system that people are faced with to make it more accessible and more appropriate for the everyday experience, which, you know, is really significant of managing volatile incomes.
Yeah, and I would add to that, I think financial education can mean a lot of different things, right? And there's really creative financial education out there. I think what we found was, one, it needs to come at the right time. So this example that Haley gave of the couple who were spending, you know, an incredible amount of time just thinking about a way to do their weekly grocery shop, that's not the moment where, you know, someone teaching you about different, credit card options is the right time. But there are moments in everyone's life where you do take a step back and you think about your financial future. And if it can come at that point, it might make a real difference. And I also think we did one deep dive on financial literacy where we asked people some really common basic financial literacy questions around interest, etc. And it was really interesting to see, like, it was not that people didn't understand the concept of interest like everybody does. But in their comments, they were like, well, but this isn't how I make decisions because that's not what applies to me. What applies to me are when do I have to pay this loan back? When is my income coming in? How am I managing across different things? And so it wasn't a lack of theoretical knowledge, it was a lack of like applicable knowledge, I would say, that was helping them make decisions. And so I agree with Haley. I think overall it's about product design in the system, and then it's about financial education that actually fits your purpose and your context in the right moment.
So we're talking about really all aspects of our financial system and the gap that we're seeing between how that system works and what is really, very much a new normal for so many millions of people. So what do you think are the reasons for that gap? What are the barriers to the sort of positive practical steps that we'd love to see?
I think some of it is just, and that's why we kind of called in the beginning, we talked about income volatility as a hidden vulnerability, is that because a lot of surveys are annual, right, we don't see it necessarily. Like, we had participants in our sample where if you look at their annual income, you'd be like, well, you're moderate income, like you're not rich, you're not wealthy, but you're also not among the most vulnerable in the UK. And so you just assume that their finances are okay, basically. And you don't see all of the up and down that happens within that figure and all the effort that goes into managing that. So I think that's a really big deal. And then the second one is also that I think the people who are designing policies and products often are part of a group that has a monthly regular salary. And it's really hard to imagine that for a lot of people, life doesn't look like that. And so I think it's both of those things of just kind of recognizing that annual numbers don't tell the real story day to day, and then recognizing that the people making decisions might be in a different employment setup or in a different kind of context than the people experiencing volatility.
Great. I'm going to start to bring in a couple of questions from the audience as we go through some of the themes that have come up. So just on those financial products, a question around, did you see any examples of financial products and services that were working really brilliantly for people on volatile incomes?
Yeah, I think one that worked quite well for a lot of our participants was kind of earned wage access products. I think there was quite a few participants who were using those quite successfully to help them manage their income and when they got their income and when they needed it and so on. So that was something that worked really well for people. I think coming back to Chris and Susie, the functionality to have multiple pots and manage your money, kind of create different segments within a bank account. So yeah, being able to customize how you manage your money in your account as well. That seemed to be one that was very popular with a number of our participants, Chris and Susie being one of the most extreme on that regard. Anne, are there any others that you would flag?
Those two definitely, and I think also we had a few participants who were banking with credit unions or other kind of suppliers of affordable and responsible credit who spoke really positively of that experience of having access to credit when needed, but in a way that felt cared for and it felt responsible rather than kind of being exploited. So I think that definitely has a role as well.
Great. And a question then about some of the strategies that you found being used by the households participating in the study for smoothing their consumption through the month when balancing multiple incomes. What sort of things were you seeing? And additionally, what sort of challenges about doing that on a monthly basis are distinctive to those on the very lowest incomes as opposed to those on moderate incomes?
I think the number one strategy we saw was transfers between accounts, which was really fascinating in this project because people were connecting their actual accounts and not just kind of giving bank statements of what was coming in and coming out. Like, we saw the majority of participants definitely making weekly, sometimes daily, sometimes multiple times daily transfers between one current account and another current account or an accessible savings account as part of kind of a mental accounting exercise to be like, okay, I know this bill is coming out in 3 days. So I'm going to put aside some money into this account, but I also need some money in this account because I need to go grocery shopping. And so I'm going to put it here. And so really, as Haley said, having these different pots and different kind of mental associations with different types of money, which worked really well for a lot of people to stay on top of things, and also takes an incredible amount of effort to constantly be tracking, where's my money going, where do I need it next, what's the most urgent priority in terms of expenses. And I think the difference there for people who are on a particularly low income is that the question is, is that enough to make your income stretch to meet your expenses? So if it's not just about volatility, but also about the amounts not kind of matching up. And so we saw people constantly having to change plans of like, I'm going to put this aside for this next bill, but then actually something else came up, so I'm going to take it back. I'm going to try to see where I can get it out from. And so not for everyone, that system actually had enough money to go around in a way.
Yeah, definitely.
I don't know if you want to add to that.
Yeah, I think, you know, people were kind of cutting back, not always to the extent of like not having food or not having fuel, but there were a lot of examples where people said, well, I only put £5 fuel in my tank because I didn't know if I could afford more and I needed to hold money back for this, or I needed to buy food, but you know, I didn't have that much money, so all I bought was beans and soup or something like that. So there were lots of examples where people were kind of, yeah, limiting their consumption in order to make sure that they had that money there when they've been moving it around in the way that Anne said.
And this issue of that constant mental load and calculation and always being on one's mind has come up in quite a few questions and is really striking in the research. What did you see in terms of how that sort of mental busyness and stress might have been crowding out longer term savings?
Oh, it definitely had an effect. I mean, the thing about what people are doing that I really think is important to get across is they're managing the money in the now and a constant forecast process, right? So they're anticipating what might be coming up, what might happen. And I think that constant navigation between present and future is really challenging to manage. What might happen next week? What lunches might my kids need next week and things like that. So it's a huge burden. It definitely was crowding out the ability to think more long term. I mean, people caught up in this process, and I'll use Susie and Chris because they were one of our case studies we just talked about, but they were literally felt like they were just hanging on. They used that term a lot, just hanging on, managing this, and they were looking forward to a future where they wouldn't have to live like this, where they could just take a step back and just know that their money was there. During the project, the first milestone they were looking towards was the new childcare rules that came in April, because they thought they would get and some money saved from that, from their youngest child who was in nursery, and then that would help them have a bit more of a gap to be able to think about longer term saving. But unfortunately, they didn't quite get as much benefit from it as they hoped. So then they were like, well, once in September, the youngest one will turn 3 and have full free childcare. So it's like hanging on to the next milestone. But really, in the meantime, it was they were completely kind of, you know, worn out in this regard. So yeah, they were saying we can't think about savings right now. We'll have to think about it after April, after September, after this month. And it kind of felt like just a never-ending saga for them, really.
And I think for me personally, one of the things I learned that was really interesting to me was that often when we speak of savings, we speak of savings totals, right? We say things like this percentage of the population doesn't have £500 in savings, and that's a really important indicator. But actually, there's a huge difference between engaging in the behavior of savings and accumulating savings. And I would say, with very, very few examples, everyone in our sample engaged in the behavior of savings. Like, people were putting money away, sometimes for the short term, sometimes with an aim towards the long term. It just didn't always pan out that way. They often had to draw on those savings. And so we saw people where, when you look at their transactions, you're like, whoa, what happened that month? There's £10,000 floating around. But actually, it's the same £1,000 just being put over and over into savings, withdrawn, put away. So there's a lot of effort and ambition to save, but it doesn't necessarily mean that you walk out of the month or out of the year with actually savings accumulated. And I think that's a really big difference.
I mean, this research really crystallizes, I think, the point that Nest Insight is frequently talking about the role, the central role of household financial resilience in broader economic health, because we saw so many examples in this research, didn't we, of people's personal potential being limited by income volatility in ways that were beyond their control, even taking lower paid jobs simply because they would provide a regular income and therefore being limited in what they could achieve and do. So it's all about quality of life as well. We've had a few questions about how we conducted this research. So I'll just bring in one or two of those. Would you like to cover how we went about finding participants? What was in it for them? Did we reward them in some way? How did we build on those relationships and really getting people to share very personal information with us?
Yeah, it was something we thought about a lot, obviously, because like we were asking people for a really, really in-depth insight into their lives. So first of all, as I said, this was a collaboration between Nest Insight, Aston University, and Glasgow Caledonian University, which was incredibly helpful because we're all in different geographies. So Nest Insight sits in London, Aston sits in Birmingham, and Glasgow sits in Glasgow, obviously. And so in terms of recruitment, that first of all helped kind of, I would say, tap into different recruitment networks. And so we worked with professional recruiters, but we also worked with community organizations and other networks to bring a diverse set of people into this study. We put a lot of time and effort into trying to develop both recruitment, but also onboarding and consent materials that were as accessible as possible. So Haley, for example, did a little video that people could watch. Members of our team would call potential participants and explain, because we just realized we're asking so much of people, like there needs to be a really personal touch to it. We can't just give you an info sheet and be like, by the way, connect your bank account, we'll see everything, like don't worry about it. And I think that made a real difference, especially around the transaction tracking, that people could ask questions about. So what exactly do you see? You know, are you able to make transactions on my behalf? Obviously we weren't, but just to explain that really closely. And I think as a result of that, we saw incredibly low dropout. We had a few people at the start who signed up or maybe did the first interview and then decided this isn't for me. But I think with one or two exceptions, everyone who actually started then went through the entire process, because we had built this kind of upfront trust. And obviously because you develop a relationship as well, like when you meet someone every month, you start to get to know them, they start to get to know you, which was really lovely. We did compensate for people's time. So we paid a monthly incentive just to compensate people for the hour they spent with us on the phone or in person. Where needed, we reimbursed childcare or transport expenses if people were meeting in person. So we tried to be accommodating in a way that was ethical to participants, to recognize the time that they were putting into this project. Haley, I don't know if you want to add anything to that.
Yeah, I guess just that it struck me that we kind of added a whole step into the recruitment process, I would say, of those kind of pre-conversations. So it took a lot more time than we anticipated, but the payoff was then that we ended up with a very, good retention rate throughout the project. Each of the households worked with one researcher, so we met with people regularly over the course of the project. We did sometimes switch around if people were, if people weren't available or on holiday, things like that. But generally, participants built up like a good relationship with the researcher they were working with, and that was a really nice aspect to the project, because it meant that we had these really good relationships. We knew a lot about our households. We still talk about whose household was whose, so I'll say, oh, we're going to present about Milena. Anne, is that one of yours? And things like that, because those relationships were really strong. So it was a lovely side of the project, actually.
Great, thank you. So let's turn to some of the solutions and ways forward. So question has come in about the debt advice sector. Did you come across anyone who engaged with debt advice during the research, and any insights that sector should consider around the way that advice is structured and delivered, that might make it easier for people with volatile incomes to engage with?
Yeah, I don't think we had anyone who was engaging with debt advice during the project. We did have some people who had previously engaged with debt advice. We had a number of participants who were either under, managing a legacy debt, so with a debt management payment plan or an IVA, who had previously engaged with debt advice before. I think there were, maybe Anne has got some more insightful things to talk about specifically, but generally, I think we saw there were people who had been very proactive about going to those sort of debt agencies and getting help when they needed it. There were also people who probably could have done with that and at different parts of their lives and hadn't done that, and didn't feel able to. The kind of stigma around that. So I guess the main thing I would flag is just that not everyone is aware of them, and not everyone feels able to go to those sort of services. So I don't think that's a kind of radical point. I think we were very aware of those structures of stigma that prevent people from engaging with things like debt advice. But Anne, did you have any experiences to flag around that?
Yeah, I mean, I think what we can share maybe broader around the topic of debt, like as Haley said, we did have quite a few participants who had accumulated debt in earlier stages of their life and were under some kind of management plan to repay that back. I mean, first of all, there were a few participants for whom, depending on the volatility that month, like that debt repayment was a significant outgoing. And I think there's a balance there between needing to create stability in repayment and expectation of what you were supposed to repay, and also recognizing that in a low income month with maybe only 4 weeks in those shifts, it can put people under financial strain, which might not be the case the next month necessarily. And so I think there's a balance there. What I would also say, what we saw generally around debt was that there were different perceptions of different types of debt. So we saw quite a lot of use of informal lending, which was seen cautiously, but generally quite positive, like not something that you would overuse. You were definitely very careful about the relationships that it might impact, but it was a lifeline for a lot of participants and really important in terms of flexibility. While attitudes towards more formal debt and credit, often because of negative experience in the past, were a lot more mixed. And there was a huge, for I think a lot of participants, a huge motivation to pay that debt off and get out from under it, to an extent that I think sometimes they were paying off debt faster and at amounts that maybe were putting them under quite large financial strain. And I think there was a really important component to debt in terms of the emotional connection you had to it because of like personal experience. So we had quite a few participants who had grown up in households that were under debt, for example, or had seen a lot of kind of chaos around that in their childhood, or had gone through some kind of personal relationship breakdown and some kind of trauma that caused debt. And I think recognizing that in giving out debt, but also in debt advice, that it's not necessarily, and I'm going to say this in like quotation marks, an economically rational attitude to debt, but it really depends on your personal experience, on the relationships that you've had with debt in your past, that will influence how you use debt and how you want to pay it off. And I think recognizing that is really important and making plans that work for people.
Yeah, actually, just a big factor was often relationship breakdowns. We had a number of the people that had previously had sought out debt advice services. It was always because of a relationship breakdown, where it often was because of that, where they'd had to quickly set up a new house by themselves, especially if there were kids involved and things that often involved a lot of costs. So yeah, I think taking that context into consideration is important, as Anne said.
Absolutely. So we have a question about price differentiation, and the question is whether policies would if have a good effect, such as making it illegal to charge high prices for payment by instalments. So just to say on that, it's probably slightly beyond the bounds of this research and its conclusions. Something that our friends and colleagues at Fair by Design have wrestled with a great deal, and we did have the great news last week that the FCA has a new responsibility for those who are financially vulnerable, which is really, really good news on that front. I would just move to the question about, we had a question about community support. Sorry, my window. Yeah, so a question from Chris Fusi about community and relationships and the importance of those for people experiencing volatile income. So how might we encourage credit unions or formal community financial networks to be more prominent in the wider policy landscape?
Interesting question. I mean, we definitely saw that communities were important, and people reckon their community in the way that works best for them. So sometimes it's family members, sometimes it's friends, sometimes it's other groups like church groups or friendship groups that kind of provide that support around financial well-being. And that support is a variety of things. So Anne mentioned informal support informal loans. We saw a lot of informal loans between friends and family. That was a key lifeline for lots of our households. But we also saw kind of financial advice, support, just chatting about it. You know, a lot of our participants actually said things like what they want is just a kind of safe sounding board, someone comfortable they can just talk to and share ideas or share what they're thinking about their money and how they manage it. So some participants did suggest that they felt uncomfortable going to kind of formal financial organizations to do that because they felt like they'd always be, you know, being sold a product or, you know, potentially being marked as not eligible for something because, you know, the way that they were saying they were struggling with money, for example. So I think it's really important that we kind of recognize that people need communities to support their financial well-being and their financial lives, but also that we need this like informal aspect to it, right? It's not necessarily something that I think can be developed from a top-down way. It's very organic and bottom-up. So finding ways to support those processes without actually kind of determining them or, you know, making them too structured or too systematic, I think is really important for thinking about the role of communities in financial well-being.
Yeah, I would agree with that. I think we sometimes fall into this trap of thinking that informal is somehow lacking and we need to replace it with formal. And I don't think that's true. I think we can strengthen informal community relationships and family relationships. And I think we can learn from them. So if I think of why participants might go to informal sources of support, it's, I mean, first of all, it's trust, right? Like you feel understood. There's an atmosphere of feeling accepted. So I think that's something we can replicate. It's flexibility a lot of times where, you know, like, you know that if you take out a loan, the other person will let you pay it back when you have the money. You know, that like there's a commitment, and people took these commitments incredibly seriously, but with some flexibility. But I also think there's a level of control there. Like, you don't ask unless you need it. Like, it's not nothing to ask a family member or a friend for support, for example. And so I think formal institutions can learn from that in terms of providing an environment where you feel comfortable and not judged, where you provide as much flexibility as you can, but you also provide this kind of critical friend, like almost like attitude of like, you only ask for this if you really need it, but if you do ask for it, you feel understood in a way.
Mm-hmm. Absolutely. So just come up with a final couple of questions that have come in. So a question about the incentive for financial services providers to create products that better meet the need of these households. And we did have another question about the wider system and how it is working and creating barriers in a very systemic way. Do we need more investment in mutuals, credit unions, other newer appropriate options coming into play? Financial services are big businesses, but what we found in this research, of course, is that this is a very large group of customers who should be ignored at financial services peril, of course. But in that, where are the incentives that will lead to the outcomes that will better meet the needs of these households?
Shall I have a go at that, Haley, and then we? So, I mean, I think that the answer is yes and yes, right? Like, I do think there needs to be more investment in credit unions and mutuals and these kind of like accessible and fair institutions that are specifically set up to serve certain parts of the population. And I would also say, like, as Haley said, like, some of the tools that were working for people were quite new tech-enabled tools, such as having different pots, having kind of an app that allows you to structure your spending or recognize your spending, using earned wage access. Those are tech startups, right? And I mean, I think they are quite incentivized to grow their customer base. They're being really profitable on the back of that. And so I don't think I would write off these consumers as like, oh, they need to be served by a special kind of institution. I think it's really smart product design to a certain extent that is already happening. And it might just be about going away from this perception that these new tech products are just for like young, hip, middle to high income people, but they can work across the population, and we can design them that way as well, because there's millions of people that might want to use them.
Yeah, I think I agree with Anne. Like, what we found is that having a volatile income is not necessarily that much of a marginal experience as it might have been thought, but these tools would still be useful for people who are on stable incomes, right? Like, just because people is not so much pressing need for them, it doesn't mean that, you know, if someone's got a stable income, maybe they don't feel as much of a pressing need right now, but it doesn't mean that that situation might not change for them in future. And, you know, even if their income stays stable, unexpected things happen that might mean they need these tools. So I think rather than thinking about these as things that just appeal to a small, or marginal segment, a big minority, but still marginal segment, I think they're things that can improve everyone's engagement with financial products and services, so that even the bigger businesses should really be looking out for these sort of things.
Thanks. Absolutely. If we get it right for these households, we will get it right for everybody in all of our diverse lives. So we've come to the end of our time. Thank you very much for joining us and for all of your questions. Please look out for future events online and in person from Nest Insight. We'd love to meet with you and tell you more about the other strands of our research. For example, we are continuing to look at the role of opt-out emergency workplace savings to build financial resilience. And we're also looking at the particular experience of self-employed people at the moment as well. So thank you all for coming. We're going to close there. Any other questions, do get in touch with us, and love to keep in touch with you all. Thank you.